Welcome to our channel. Disclaimer, I am not a certified financial advisor or a certified public accountant, so do your own research and talk with a professional. I am just a guy interested in investing and hopefully hitting 7 figures in assets soon. I also recommend reading some investing books as they provide much more detailed information. I recommend checking out the Boglehead books, ETF Investing for Dummies, and Investing 101 series books. Today, we're diving into the world of passive income and exploring how you can get rich slowly but surely. I know it's not as exciting as becoming a millionaire in one day, but unfortunately, I don't know the path to riches in a day other than winning the lotto or robbing a bank, I guess. We'll be covering a range of strategies, from low-risk options like high-yield savings accounts to potentially higher return, but also higher-risk investments. Remember, there's no magic bullet when it comes to building wealth. It takes time, discipline, and a solid understanding of the opportunities and risks involved. So, buckle up, and let's get started on your journey to financial freedom. All the topics we're going to address are types of passive income. Passive income is money you can make without putting out any extra effort. Active income is basically the back-breaking money you make at your 9-to-5 job. But let me be clear, investing in crypto is basically gambling, so don't invest any money you can't afford to lose. More likely than not, you will lose any money you invest in crypto. If you still want to take the plunge, sticking with Bitcoin or Ethereum are probably safer. But then again, the words safe and crypto should probably not be in the same sentence. Do not invest more than 1% of your portfolio in crypto to avoid bankrupting your portfolio and falling into a deep depression when you lose all your money. I am just listing it to be thorough in the types of investments that are available. Let's talk about cryptocurrency, the Wild West of investments. Stories of striking it rich with Bitcoin or Ethereum are common, but these assets are volatile. You can earn passive income through staking. It's like earning interest on your crypto holdings. Lock up your coins to support a blockchain network and earn rewards. Yield farming offers high returns but comes with higher risks. Do your due diligence, understand the technology, and diversify your investments. We'll cover more stable passive income strategies in upcoming chapters. Let's face it, traditional savings accounts offered by brick-and-mortar banks barely keep up with inflation. That's where online savings accounts come in. These accounts typically offer much higher interest rates comparatively, allowing you to earn more on your money while still keeping it safe and accessible. Most online bank accounts are FDIC insured up to $250,000. Interest rates on savings accounts are continuously variable. The beauty of online savings accounts is their simplicity. You open an account, deposit your money, and watch it grow with minimal effort. Plus, many online banks have low fees and minimum balance requirements, making them accessible to a wider range of savers. While online savings accounts might not make you rich overnight, they're a fantastic foundation for building a solid financial future. Remember, slow and steady wins the race. Now, if you're looking for a bit more predictability and a guaranteed rate of return, certificates of deposit or CDs might be your thing. With a CD, you agree to keep a certain amount of money deposited for a fixed period, ranging from a few months to several years. In exchange for this commitment, the bank offers you a higher interest rate than you'd typically get with a regular savings account. CDs are a great option if you have some money you won't need immediately and want to protect it from market volatility. However, keep in mind that your money is locked in for the duration of the CD term. If you withdraw it early, you'll likely face a penalty. So, CDs offer a predictable return in exchange for less flexibility. But they are just as safe as a savings account, as they are also FDIC insured up to $250,000. In my lifetime, I have seen CD rates anywhere from 0 to 6%. If you can lock them in at 5 to 6%, They are basically a better bet than bonds, which usually return 5% average and are not FDIC insured. Let's dive into the world of bonds. Now, bonds might sound complicated, but they're essentially loans you give to governments or corporations. When you buy a bond, you're lending money for a set period at a fixed interest rate. The issuer of the bond agrees to pay you regular interest payments, known as coupon payments, and return the principal amount when the bond matures. Bonds can provide a steady stream of income and are generally considered less risky than stocks. However, bond prices can fluctuate depending on interest rates and the issuer's creditworthiness. It's essential to diversify your bond holdings, just like with any other investment. Consider investing in bonds with different maturities, credit ratings, and issuers to spread your risk. You can also consider bond funds or ETFs. They are similar to regular bonds as far as return rate, but are also a little similar to stocks. The price of a bond fund is not guaranteed and can fluctuate like stock prices. Thus, you can actually lose some money with bond funds. You can usually mitigate that risk by picking a shorter duration bond fund. Now, let's talk about two popular investment vehicles: mutual funds and exchange-traded funds, or ETFs. Both offer a convenient way to diversify your portfolio and potentially generate passive income. Mutual funds pool money from multiple investors to invest in a diversified basket of assets, such as stocks, bonds, or other securities. They're managed by professional fund managers who make investment decisions on behalf of the investors. ETFs, on the other hand, are similar to mutual funds, but trade on stock exchanges like individual stocks. They typically track a specific index, sector, or asset class, and offer investors a low-cost way to gain exposure to a diversified portfolio. There are both similarities and differences between mutual funds and exchange-traded funds. Both are relatively safe, and definitely safer than individual stocks. ETFs can be traded in real time like stocks, whereas mutual funds are settled at the end of the day. They are both usually a basket of stocks, which can be anywhere from 10 to 4,000 stocks, which mitigates single stock risk. If you like to buy frequently in small increments, it is better to invest in mutual funds as ETFs incur trading fees. There are brokerages with free trading. If you bank with Bank of America and have $50,000 in assets, they give you free trading. ETFs tend to have a lower expense ratio than mutual funds. When it comes to passive income, look for mutual funds or ETFs that focus on dividend-paying stocks or bonds with a history of consistent interest payments. These distributions can provide a regular stream of income, whether you're retired or still building your wealth. Now, let's dive into the world of dividend stocks. Total stock return is a combination of dividend return plus stock price appreciation. Dividend stocks are the safer option, whereas growth stocks have higher risks. When you invest in stocks, you're essentially buying a small ownership stake in a company. Some companies choose to share a portion of their profits with shareholders in the form of dividends. Dividend-paying stocks can be a great source of passive income, providing you with a regular stream of cash flow from your investments. When choosing dividend stocks, it's crucial to consider the company's financial health, dividend history, and growth potential. Look for companies with a long track record of paying dividends consistently and increasing them over time. Dividend investing is a long-term game. Reinvested dividends can significantly boost your returns over time through the power of compounding. Remember, diversification is key, even within your dividend stock portfolio. Real estate is a popular investment for passive income, but often requires significant capital and comes with landlord hassles. That's where fractional real estate and REITs come in. Fractional real estate lets you invest in a portion of a property, lowering the barrier to entry. Websites you can research for fractional real estate are Arrived Homes and Fundrise. Earn passive income through rental income and property appreciation. REITs own, operate, or finance income-generating real estate. There are many options for REITs, but you can check out VNQ, which is a pretty safe option. They trade on stock exchanges, making them liquid investments. REITs distribute taxable income as dividends, attractive for passive income seekers. Both offer diversification and passive income potential, but research platforms, fees, and risks involved. Now, let's talk about traditional real estate investing, a path that's helped many build significant wealth over time. Just like with any real estate purchase, make sure you don't over-leverage yourself. Try to at least put down a 20% down payment. Not using a sufficient down payment can increase your monthly mortgage and may also require taking a second mortgage versus paying private mortgage interest. Owning rental properties can provide you with recurring rental income and potential appreciation. However, it's also a more hands-on investment compared to some of the other strategies we've discussed. Being a landlord comes with responsibilities, from finding and screening tenants to handling maintenance and repairs. You'll need to factor in expenses like property taxes, insurance, and potential vacancies. Thorough research is crucial before diving into traditional real estate. Consider factors like location, property type, rental demand, and potential for appreciation. While it requires more effort, traditional real estate can be a rewarding path to building long-term wealth and generating passive income. Thanks for watching. We've covered a range of passive income strategies, from low-risk options to those with higher potential returns, but also higher risks. Remember, the key is to find what aligns with your financial goals, risk tolerance, and time horizon. Building wealth takes time and effort, but by diversifying your income streams and staying consistent, you can achieve financial freedom. Don't forget to like, subscribe, and hit the notification bell for more tips on building your wealth slowly but surely.